So next we'll take a look at different types of trading bots. The first type we'll focus on is high frequency trading and the concept behind many bot trading strategies. So high frequency trading is a type of algorithmic trading where large amounts of orders are executed in fractions of a second. This is an instance or a scenario where bots are programmed to pull financial data and other market analytics to make trades almost instantaneously, faster than what a normal human would be able to do. Now, these types of trades aim to capture small amounts of profit in each transaction that will turn into a significant profit over time. And one way to think of this is it's basically an extreme version of scalping where it's automated and faster. We don't have the human element where it's only looking at the 5-minute chart or maybe the 1-minute chart or maybe even something in seconds, and it's trying to scalp small amounts of percentage gains on those moves. You have something where you have a bot that's able to do tens of maybe hundreds of trades in the same amount of time that a human trader would be able to do, and is still aiming to capture these small amounts of profit in each transaction that if it's run long enough and in the right conditions, it'll turn into a significant profit over time. Now, competition between high-frequency trading algos can be fierce, as programs with faster execution speeds will have advantages over programs with slower processing speeds. And now we're starting to get to the point where it's not just about, I'm having a bot trading program that can beat the rest of the market because everyone else is trading as humans. There's other people doing this as well, and this has been going on for years, several years, not just in crypto but in traditional markets. There's several studies that are suggesting that there's large amounts, maybe 70-80% of trading is actually done by bots. So this is something that we have to continue to monitor. Here we see competition is continuing to increase because people, institutions, hedge funds are using more and more advanced trading bots. They have people on payroll specifically just to create these bots and to maintain and operate these bots. So the competition between these different algorithms is fierce and is only increasing over time as technology continues to improve. So here are some studies on higher frequency trading algorithms. So the following slides show the results of a study on HFT released by the Quarterly Journal of Economics. This is a few years old, but it's still relevant to the concept of high frequency trading. The study compared the differences between two different financial instruments that track the S&P 500 index. The first one was the SPDR S&P 500 ETF, which is the ticker's label is $SPY. And then it compared it to the S&P 500 E-mini futures contracts, which is $ES. Now, while both are created to track the price and the price action of the S&P 500 index, both were seemingly correlated on high time frames such as the daily and the hourly, and there was much correlation. They were pretty much tracking the index as well as a financial instrument created to track an index could, right? It's seemingly correlated movements. It's taking on the similar market structure. A closer look at the extremely low time frames such as the 1 minute and the 250 millisecond chart show that the two would actually deviate from one another frequently. So here's an example. This is the daily chart. As we could see in blue, we have our ESPY futures, and then in green we have our SPY price. And pretty much they were tracking the same price over the same period of time. Much correlation. This is on a day's worth of time movement. So from 9 to about 2 o'clock. So a couple hours worth of price movement, but much correlation, as we could see. Price is moving up in the same pattern, and typically drops down here and then comes back up. This is the same chart, but on the hour time frame, and this is from 1:30 to about 2:30. Here we see, once again, much more correlation similar to the daily. We're seeing dips occurring in both assets at the same time, peaks and valleys, market highs occurring at the same time on the asset, and just a general market movement. So, we could say there's a high correlation between the two. They're both showing the same amount of data. Now, when we turn to the lower time frame, especially the extreme lower time frame, such as the minute, this is where we start to see deviation between the price patterns. We see here the E-mini futures. It's a much different story in terms of price movement compared to the SPY, the ETF is shown here. We see generally the general price trajectory is the same, but we start to see fluctuations. There's a lot more fluctuation here in the SPY, whereas the ES is much more flat, much more rigid in its price movements. And interestingly enough, here we see this increase and then a short dip, a retracement. We have a much more rigid price movement in the ES. Now, taking a look at the 250 millisecond, we see this actually is exacerbated, where there are times, and we start to see contrary movements, divergences. Particularly here, this is one that really sticks out. The SPY actually increased during these 250-second time period, which is a matter of seconds. At the same time, the E-mini futures actually decreased, and this is something that really can't be traced or traded by humans, right? There's no way that you can actually sit there and trade the 250 millisecond chart. You can't process analytics that quickly, but a bot can. And this is indication that, well, if there's this much deviation between the two assets and there's this much fluctuation and volatility, it can't be due to human traders, right? This has to be under the influence of automated systems that are able to calculate and base trades in milliseconds, in seconds. And even the 1 minute chart, we go back to the 1 minute chart, we do start to see these deviations over time. And something in every minute is slow to bots, right? For us, for humans, we think of the 1 minute chart and something that's so volatile and is all over the place, but minutes for an automated program that can process things near instantaneously in a matter of milliseconds, as we see here, this is where we start to see this deviation and the shift where something that's automated program that is using computers to process information and input and exit and enter trades is going to have the advantage, specifically on these lower time frames. So another thing to consider with high frequency trading is that it actually helps or improves market conditions on a given exchange typically, as they provide a constant flow of liquidity and can potentially reduce higher bid-ask spreads. Remember, in a liquid market, we want to see a small bid-ask spread. We want to see a smaller difference between the highest bid, the highest buy price, and the lowest sell price. We want them to be relatively close to each other. Too big of a gap means that there's not enough buyers and sellers and that it's not a liquid market. Now, some exchanges, such as KuCoin, actually incentivize high-frequency trading by offering incentives such as reduced fees for HFT providers. We'll take a look at KuCoin's platform and how that operates in the next few slides as well. Now, high-frequency trading can also significantly increase market volatility, as these machines can make decisions in milliseconds without any human interaction. The liquidity provided can appear and disappear extremely fast, which can prevent other traders from being able to take advantage of it. So if you see prices at a certain level and you turn away and you go to turn on your computer, there's no guarantee in an extremely highly liquid market, especially with something like high frequency trading and in a already volatile market such as crypto. There's no guarantee that those prices are going to be there a minute or two later. We could be looking at something significantly lower or significantly higher based on the asset and what's happening in the market at that given time. Also, consider this. High-frequency trading algorithms are actually responsible for a significant amount of trading volume in global markets, as we've said before. So according to a report by CNBC, about 80% of daily trading volume in the U.S. alone is done by machines. So there's actually a significant amount of automated trading happening already, and this is something that will continue to grow over time. Here's another study. This is a study based on the stock price with and without high-frequency trading. So as we can see here, with high-frequency trading, there's a bit less deviation in terms of shifts. So while we may see more instances of this volatility, it may not be as severe, and we also will see typically we'll see less severe bid-ask spreads compared to then without high frequency trading. We may see more of these larger gaps in between prices and in between bidding prices and asking prices.